I'm proud to welcome you to a special series of the Exceptional Advisor podcast. Hi, I'm your host, Bob Powell. Over the next several months, this special series will highlight exceptional advisors in these extraordinary times. We hope this series helps you to better serve your clients, to differentiate yourself from the competition, and enhance your ability to communicate those differences in light of the unique challenges and emerging norms of the current times. Today, my guest is Dorothy Bossung, an Executive Vice President with Lowery Asset Consulting, Chair of the RMA Commission, and Vice Chair of the Investments in Wealth Institute. So, welcome to the podcast, Dorothy.
Thank you for having me.
It's a pleasure. So, before we get to the meat of our discussion, do you mind starting by telling us a little bit about yourself and your background?
Sure. I'm an Executive Vice President and Senior Consultant at Lowery Asset Consulting. Lowery is a boutique registered investment advisory firm that helps high net worth individuals, business owners, nonprofits, and associations with their investments and planning issues. This runs the gamut from helping struggling nonprofits put together cash management and investment policy to helping retirees, pre-retirees make sense of their investments, their income, their benefits, begin a new phase in their life, if you will. And it's also lately been helping more folks who are widows and widowers who are struggling with yet one more change in their lives, the loss of their spouse.
So you have also been involved with the Investments in Wealth Institute for many years and in many different ways. Do you mind giving us an overview of that too?
Sure. Yes, I have. I've been a member of the Institute for quite a while, but I've also been involved as an active member. And that means that I don't believe in just joining as a member. I believe in participating, getting to know folks, and really getting to find ways to give back to the organization that ends up giving so much to me. And I think it works both ways that way. So I've served as a subject matter expert in the CIMA work and the CPWA work, and also the RMA work. So it would be certified investment management analyst, the certified private wealth advisor, and the retirement management advisor. I've served on the commissions for the CIMA and the Wealth Commission for CPWA, and I now chair the Retirement Commission for the RMA. In all of those, we're working to improve upon the program and make sure that the material that's given to the individuals who are in part of the program is very relevant to their jobs on a day-to-day basis. I'm also on the board though too.
And you're on the board as well. So you mentioned all the certifications. I'd be hard pressed to identify someone who knows about as much of these certifications as you do so intimately. Can you talk a little bit about the degree to which the certifications have helped you in your practice with your clients?
Well, there's not a day that goes by that I don't use those certifications, whether it's working on an asset allocation or evaluating a portfolio manager or a prospective client's portfolio, which the CIMA prepared me for, or looking at comprehensive planning opportunities for individuals and the new and current clients with the CPWA. For example, I just have a recent prospect that I'm working with that I'm using my CPWA skills with, dealing with issues regarding the estate for her recently deceased husband, gifting and planning opportunities for what she can do with her children as a part of this, and then taking on the management of the portfolio and supervision of some other advisors that she's utilizing, using my CPWA, CIMA, and RMA designation, because there was retirement assets involved with this, as well as maintaining her income now that her husband's passed away. So every day.
So here we are, we're recording this in early August. We're still in the middle of the COVID-19 pandemic. Can you talk a little bit about how your practice has changed and also how your clients are holding up during this period?
I was very lucky in some respects in that I had decided to work remotely from my office at the end of 2018. So I was really set up for this before before it happened. And I think that helped a great deal from my own personal perspective. Folks in the office got used to working with me remotely. I got used to working remotely with them. I see my clients face to face on a quarterly basis and go through their portfolio and their personal issues and so on. But being ready to deal with these things remotely in terms of the office was helped by that early start. The clients are used to seeing me though face to face, as I just mentioned. And with this COVID situation, I have not physically seen a client since I delivered the fourth quarter reports to them for 2019, but we've been having ongoing dialogue on the phone, and I spend a good deal of time on the phone checking in with them. But I think it's also kind of funny because they call me to make sure I'm okay because they knew the market was down and all, and they wanted to make sure that I was okay and I was holding up so I could be there to watch their money. We're setting up some Zoom calls, and the office uses Ring Central calls for the second quarter reporting now, and that'll be an interesting experience in walking them through the technology on the other side, because some of them can't manage to send me a fax and get the fax machine working. So this will be an adventure. At the very least, we'll have conference calls. Talking to them live, I think, is invaluable.
So, obviously there are a good many young advisors out there who haven't experienced this type of difficult environment. What sort of advice might you have for those folks?
Well, I think there's probably two things that I would mention there, and it goes back to what I was just saying. Pick up the phone. Younger advisors are very comfortable with texting, sending emails, and so forth, and they forget that the phone conversation, that personal touch, if you will, of calling the client on the phone and having that conversation is something that clients really value. You've taken the time out of your day to reach out to make that phone call. And that doesn't mean you can't send them your latest 10-page market summary that you worked so hard on and everything else. But the fact that you made the effort to make that phone call makes a big difference. The second one is I would really underscore the fact that it's more than just the investments in the portfolio or the one thing that you happen to be reaching out to them for that day, whatever it happens to be. You need to look at the clients holistically and take into account all of the things that are impacting them in this difficult time. When you call them up on the phone, make sure that you have that personal information in front of you. Ask about their kids, their mom, their spouse, see what's going on in their lives beyond what's just simply happening with respect to the portfolio. You'll find a great deal of other ways that you can work with the client if you take the time to do it that way as well. That can make a big difference.
So for some folks who may not have all the advanced certifications that you do, this might be an opportune time for them to look at that too if they're a young advisor and thinking, what else do I need to do in order to deal with times like these?
Absolutely. Absolutely. If you don't know how to approach things from a holistic perspective, because you don't have the training, by all means, this is a perfect time to be thinking about the CPWA or RMA, assuming you have the background already on the investment side of the equation. It's a perfect way to set yourself up to look at the clients holistically, and you'll get more business in the long run. People that have these certifications do. And your clients are much more likely to stay with you when market times are difficult, because they're reliant on you not just for whether or not their portfolio goes up and down, but whether or not they're going to succeed in their retirement or their goals in planning towards retirement. So make a difference.
Yeah. So obviously you've been talking to a lot of clients. What kind of opportunities have arisen with them in terms of what you might be doing strategically or tactically with their portfolios?
Well, specifically since the COVID crisis has occurred and that's driven the market down, that there are two things that I've worked on with clients. One is those that are doing Roth conversions. We did them earlier this year to take advantage of the markets rebounding back and having that rebound occur in the Roth itself. So we're effectively able to transfer more wealth that way. And we looked at opportunities to do tax loss harvesting, to bank that loss for future use in tax planning, but transferred those dollars that we got from the proceeds of the sale to a reasonably similar, but not identical, obviously, for tax purposes, investment so that we would participate in the rebound as well. And I think that's been a plus. The thing that I forgot to mention earlier is the fact that one of the reasons my clients have not been getting as worried about this market move and so on is the planning that I've done with respect to the RMA designation. Those retirees that I have, we've got money set aside in investments that are paying them the money on a monthly basis that they need from their portfolio, from their accounts, to meet their income needs. So there's not a forced sale and a big dip in the market in which they have to be going after funds to make the ends meet in terms of the monthly payments. So
yeah, we'll talk more about that in a little bit, but the notion of the RMA sort of build a floor and then upside is a key component of the certification.
Sure.
So obviously we have witnessed two significant pieces of legislation in recent months, the Secure Act and then the CARES Act. Can you talk a little bit about how those new laws have affected you and your practice and your clients?
Well, I'd say that there's been a bit more with respect to the CARES Act at this point in time. CARES Act specifically because the required minimum distributions are not required this year. So retirees that were taking money from their IRAs because they were over 70 and a half historically, don't have to take their monthly distributions. So now it's a question of, does it make sense to take the distribution this year because they're concerned about potential Biden presidency and potential tax increases, or can we eliminate those distributions this year for 2020? And what will that do to their overall planning? Where do you make up for those funds elsewhere if you don't take them from there? Mm-hmm. Additionally, I have an institutional client who applied and received PPE funds. The focus there has been finding a place to set aside those funds with some level of security so they can at least earn enough to cover the costs of the loan if the government ends up deciding it's a loan instead of a grant as a part of it. With the Secure Act, that's just been much more of a situation where clients who would have been turning 70 and a half this year and would have been, under normal circumstances, forced to begin taking distributions from their retirement accounts are getting that postponed till 72 and all. One place it did have an impact though is I had a client who passed away. So because of the Secure Act, the beneficiaries, the non-spouse beneficiaries of his IRA account will be now forced to take a distribution over a 10-year period of time. Not this year, but at some time during the 10 years following his death, so that that's covered.
Yeah, it's unfortunate that we've lost the stretch IRA opportunity.
Yes. Mm-hmm.
But
Yep.
I understand. So before we change subjects, do you have any other advice for young advisors during this time?
Again, I would say that I would focus on being sure you're prepared when you make that phone call. Have personal information in front of you, know what's going on in their lives, what they've told you already, and then think of some questions that you might want to ask before you get on the phone to at work.
Okay. So let's go back to the RMA. So many folks wonder what the value is in getting the RMA certification. I'm sure you have some thoughts about what the value of it is.
Well, I obviously believe in it. I do a lot of work on it, and I have the certification. But there's a rationale beyond that, beyond my personal beliefs. Surveys have shown the clients want an advisor who's met a rigorous set of criteria to be certified, and they want that advisor to help them set clear goals for retirement, along with an advisor that can help them maximize their income for retirement. The RMA program, helps an advisor do that and more. You have an educational process for the RMA. It's a multidisciplinary approach to retirement planning. It helps you better understand a client's mindset during the transitional time that they're going to be going through. It helps prepare you by teaching you strategies for custom risk assessment and helps guide you through unbiased solutions that can give you practical tools as well as techniques to use in your practice. Again, I mentioned holistic before. This is a holistic approach to planning for retirement. It's focused on all aspects of the client's household situation. So where you may have previously been talking to just the husband in the situation, you really need to be looking at all of the aspects of their spouse's circumstance as well, and income sources and finances. In the RMA process, you utilize tools of the procedural prudence map. That is a comprehensive summary of the process of retirement management planning. Along with that, we use something called the client diagnostic kit and the household balance sheet. They're part of that map I just referenced, and they help you walk the client through the process. During all of that, you measure something we call fundedness, which I think you mentioned just a little bit ago, to make sure that we're taking into account all potential sources of income from their accumulated assets, but also the social capital that they have, Social Security, maybe pension income, and potential human capital, which is in the form of their ability to continue to work pre or post-retirement. Is it going to be something that's full-time? Is it going to be part-time or not? And all these pieces are pulled together through the process of the RMA education.
So you mentioned the household balance sheet. And can you sort of do a deeper dive in terms of what's in the household balance sheet? I'm sure that's a term that many advisors who might be listening to this podcast may not be familiar with.
Well, the household balance sheet is a bit different than a traditional balance sheet. It takes those traditional financial planning items that you find on a balance sheet or a net worth statement, and it adds aspects of institutional planning utilizing asset liability modeling or matching. You take the net present value of those future sources of income or expenses, and you enter them as assets or liability on this balance sheet. So that's a different approach than what folks are used to thinking about when they think of a typical accounting balance sheet. What this is doing is it broadens your focus from the person who's saving or earning to the whole household spending in retirement. And it entails the unique aspects of their lives that they bring to this. Many times, it isn't just the client or the spouse who have financial needs in and around retirement. Sometimes a parent needs to provide additional support to a child, or they have a parent that they find needs additional support, possibly financing something along the lines of a reverse mortgage for their parents as they're going into retirement. So it can be an interesting and difficult time in retirement. It's not always a smooth sailing that you expect, even though you try to do everything you can to get them comfortable and make things go as smoothly as possible. Regardless, though, in order to meet these needs and work through retirement allocations, that's part of the process of solving the risk management aspects I mentioned. And we look at that in the form of decisions that are determined both by the fundedness or the ability to meet their basic income needs in the plan and the personal preferences that individual has.
So my understanding is that there are 4 risk management buckets. Can you describe them?
Sure. You're absolutely correct. There are 4 buckets. First of which is risk avoidance, or what we would call portfolio reserves. A second is risk pooling for the longevity portion of the portfolio. We don't know how long we're going to live. It's one of those unknowns going into retirement. You may have some ideas, but based on your parents' lives or your grandparents' lives and so on, but you still don't know. Risk management, which addresses the construction of the floor, that base level of income that you need. And then risk retention, or the upside portfolio, which is something that people are much more familiar with from the standpoint of the accumulation phase, which is pre-retirement. From there, you're looking at the details of the process involving implementation, account location, product selection. And then once you have a plan in place, you need a strategy to monitor and adjust the plan as needed. As much as we'd like to think we thought of everything, as I mentioned before, we haven't, we thought of most of them. There are occasionally things that pop up and they need to be addressed.
So there are many things I like about the RMA, one of which is the retirement policy statement. And you recently wrote an article that appeared in the Investments and Wealth Institute Monitor, Investments and Wealth Monitor, on the subject of the RPS. Can you talk a little bit about the RPS and the specifics of it?
Sure. The RPS, a retirement policy statement, is a summation of all the work you do with a client and the members of their household. It's taking into account everything and all the steps that you've gone through with the procedural prudence map, the household balance sheet, the risk management and retirement allocations that I just outlined. It's documentation of the plan and the conclusions and the timeline. Some may compare it to an investment policy statement if you're familiar with that, or an IPS. If you have your CIMA, you're definitely familiar with an IPS as a summation of the work you're doing with the allocation in terms of the assets and portfolio guidelines. That's in the accumulation phase, the accumulation of wealth. The RPS is similar to the IPS, but its focus is on decumulation. This substantially shifts the focus from the investments that you are used to seeing in an IPS. You're shifting the focus instead to 4 aspects. 1, the floor, the amount of your portfolio you will need to cover their unexpected or expected future expenses that aren't covered by Social Security and pension. So you think of that maybe as lifestyle expenses. Your longevity component, and this is a subset of the floor that's established to provide a guaranteed level of insured income late in the plan so you can't outlive it. The objective here is to mitigate that longevity risk, that unknown that I've already mentioned. The next aspect would be reserves, and that's the portion that you set aside to provide liquidity or ready access to cash to meet those everyday needs and unexpected expenses in the next 18 to 24 months or so. So you might think of that as the liquidity component. And finally, upside, which is a portion of your savings that exceeds what you need in the floor to provide that income, day-to-day, month-to-month, or whatever, that you can really invest for longer-term growth. This may be used for yourself in the future if you need it, or it can be used for the benefit of your heirs and so on without jeopardizing your lifestyle. So we will oftentimes refer to this as the legacy component of the planning and the RPS. Regardless of how you tackle it, though, the retirement allocations are reflected in the RPS, and this reflects both the order of withdrawals and the bands around them. How much do you need? When are you taking it? Where are you taking it from? So it's helping the client think about things before retirement. And then when they're in retirement and they can't remember, what did we say we were going to do if we did this, they can use it as a reference to go back to. It's a reference to look at when unexpected things happen and remember how they planned on handling those unexpected things. So in the case of the COVID situation, when the market takes a dip like this, and it's unexpected and it's substantial, what should they be doing? Well, first of all, they have the income already planned for with respect to their portfolio because they have that fundedness or that flooring that's a part of it. But they may, if this is a prolonged situation, have decided that they will forego an inflation adjustment to their income for the year, but just simply income that they had expected from the prior year, okay, or had been taken from the prior year. So that is a part of it. Another piece would be looking at documenting strategies for rebalancing their upside portfolio in times of extreme market strength, because you don't want to end up with an overweight in equities since you're focused so much on the fixed income or the flooring of that monthly income stream that they're getting. So we want to make sure that is thought about in terms of how to do that rebalancing and how they would replenish their reserve portfolio if there's an unforeseen event that they have to tap into that to draw it down. Regardless of how you look at it, the big difference between an IPS and an RPS is that decumulation process. Which account do you take it from first? It's not necessarily intuitive. You have to do some thinking. Does it make more sense to draw from a taxable account or a tax deferred account? Or maybe a combination of both? Every person's situation is going to be different, which is why the RPS is a very personal document. It's going to reflect the client's unique issues and situation. It's also going to be important that the client understands the success or failure of the plan is in their hands. You're the advisor. You can help them by asking the right questions, by planning in advance, by documenting their thoughts, but they're the only ones that can make this a success. It's not simply market-driven situation. It is something that will be based in part on how they behave too after they've retired and if they want to make this a success.
So obviously, the RPS is a component of the RMA program and a very big one. It would be appropriate, I think, for us to talk more about the RMA and share with our listeners your vantage point on the RMA program and its use and value to them.
Well, obviously, I'm a fan, but I'll tell you, I've been in business for many years before entering the RMA program, and I really gave it some thought, and I'd been working with individuals in planning retirement for years. In fact, when I was a young broker, I gave retirement and estate planning seminars to drum up new business. So what's taking the RMA going to do for me besides provide me with another designation? Well, when I got into the material, I was pleasantly surprised at the combination of academia, investment industry, and insurance industry material all brought together in one place. The program really integrates and builds on all three disciplines. It takes the traditional financial planning and retirement planning concepts that I learned in my CFP or CPWA program training and builds on them. It takes that client diagnostic kit and builds on it with retirement life cycle planning. It focuses on, that accumulation planning, but transitioning to decumulation planning, and the behavioral finance aspects of walking a client through that change of mindset, because that's a huge, huge part of it. It's also much more than systematic withdrawal plans, dividends, interest, capital gains. Those are just a piece of the puzzle. Essentially, I believe that this is the perfect program to set the stage for a lifetime of learning and serving clients in the retirement space. And I'd highly encourage anyone who is not an RMA to consider signing up for the program.
Well, Dorothy, we're almost out of time, but I wonder if you wouldn't mind if there's anything that we haven't spoken about that you'd like to mention, or if anything that we've spoken about but you want to reemphasize before we wrap up.
I think we've done a nice job of covering things overall. We do have, for those who are interested in more from the Institute as it applies to retirement, there is some upcoming webcasts that are going to be presented that I think that people might have an interest in. It's called, it's part of the Focus on Exceptional Advisor, I think, website, webinar edition, and that's coming up on August the 26th. It's going to run from 11 to 3:30 Eastern time, and there's a series of topics that are a part of that I think that individuals who are looking at the retirement space would definitely find informative, educational, and worth their time. So that's something I would highly recommend checking out.
Well, Dorothy, I really want to thank you for being a guest on the Exceptional Advisor podcast series. A pleasure chatting with you.
Thanks, Bob. Have a good day.
Thank you for listening to this episode of our special series, Exceptional Advisors in Extraordinary Times. My guest was Dorothy Bossung, an Executive Vice President with Lowery Asset Consulting, Chair of the RMA Commission, and Vice Chair of the Investments and Wealth Institute. Stay up to date and have the latest episode delivered straight to you by subscribing through iTunes, Spotify, or wherever you get your podcasts. If you've enjoyed this podcast, then don't miss our Exceptional Advisor webinar series, hosted by Tony Davidow, available at investmentsandwealth.org. The Institute stands ready to help you as you navigate these turbulent times with new resources, research, programs, accommodations for candidates, and certificates. For more details on resources available, visit www.investmentsandwealth.org. And don't forget to register for the Focus on Retirement Income Strategies webinar series, which takes place August 26th from 11 a.m. Eastern to 3:30 p.m. Eastern. Devin Eckberg will serve as the host of this webinar series, which will focus on practical strategies for designing holistic, goals-based retirement income plans. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. The Investments and Wealth Institute has been helping investment and wealth professionals become exceptional advisors for over 30 years. Please visit us at our website, investmentsandwealth.org, to learn more about our certifications, conferences, online learning, and continuing education programs.